Hey guys, it's Mrs. Invest. It's a gorgeous day today, blue sky, full sun. I figured I'm going to share the sunshine with you in case you are maybe in a place that the weather isn't so great and talk about a few investing truths that I think everybody needs to know. So let's get right into it with truth number one. In the short term, the stock price and the strength of the business may not be correlated, but over the long term, 100% of the time, the stock price will reflect the health of the business. So what does this mean? This means that you can't use the stock price to assess the health of the business or how good of an investment something is. And I think this is a big mistake a lot of people make. They'll be like, oh, the stock is going up, it must be a great company, it's doing really well, so I should buy in. And vice versa, oh, the stock is going down, so I should sell because the business isn't doing very well. When in reality, over the short term, these two things may not be related whatsoever. You may have a business that's slowly growing, but over time the stock is going up and down due to factors that may not be actually related to the business fundamentals. So, like for example, most recently, Netflix just had quarterly earnings, and the earnings were pretty bad. I think they lost subscribers for the first time. Their forward guidance had been reduced compared to what expectations are. And so what happened is that kind of spooked the markets in all the tech sector and caused the rest of tech stocks to go down in anticipation that their earnings were going to be crappy like Netflix's. And not all of them have released earnings, but Tesla has, and they had incredible earnings. So that's an example of something where in the short term, Tesla was getting ready to release a quarterly report that was like the best they've ever had. It was amazing. And the stock before went down because everybody was spooked that the results were going to be crappy like Netflix's. So I think this is a big mistake that people make, is they use the stock price to gauge how the business is and use the stock price as a guide of whether they should invest in the businesses or not. So for example, like, oh, this stock has been going up, it's been doing really well, so I'm going to buy in. Or, oh, the stock has been going down, so maybe I should sell. When in reality, you shouldn't be focusing on the stock price at all. You should be focusing on the health and the strength of the business, what the business is doing. So this is another reason why I don't think it's a good idea to have, so many stocks in your portfolio, because how many businesses can you truly, really keep up with, right? Like just following what's going on with Tesla stock is like a part-time job for me. You're talking about following quarterly reports, earnings, listening to earnings calls. That's what you should be focusing on in the short term. And as long as that is good in your perspective and you think the business is doing well, then in the short term, don't worry about the stock price, because if it's a good business over the long term, the stock will reflect that. And on top of that, if you've really followed a business, they're a good business, they're doing well, and the stock is down, and you don't believe it to be a reason that's related to the business, maybe it's external garbage that's going on, this is a perfect opportunity for you to go in and scoop up shares at a cheaper price while everyone else is selling. Okay, number two investing truth that everyone needs to know is that the effects of compounding pay off the most in the later years or the out years. So in your early years of investing, you may not see, tons of fruits of your labor, but that's okay, and you have to understand that that's expected. But as the years go on, you will have over time, quite literally, a volcano explosion of wealth created for you simply due to the effects of compounding, provided that you have invested well and invested in good businesses and you've held them over the long term. So don't expect magic to happen in the first couple years. Don't get discouraged. The most important thing is that you have as many years as possible in your life invested. And part of that means starting early. The earlier you start, the earlier that volcano explosion of wealth will occur in your life, and the earlier that you will become financially free and be able to do literally whatever you want. Okay, number three. This kind of goes with number two, but in the beginning, the most important thing you should be focusing on is increasing your income and your savings rate. Even if you don't even know what to invest in, how to open an investing account, that's okay. The number one thing you need to do is start saving the money that you're earning. Because getting yourself started is the hardest. Getting that initial amount of capital to get invested so you can get somewhere is the hardest. And unfortunately, again, what a lot of people do, as soon as they get out of school and start making money, they start upgrading their lifestyle and spending money on everything, fancy cars, the biggest house they can afford, huge vacations, and all that stuff is great. It's a part of life. It makes us happy. But sometimes people kind of don't think about investing when they're younger. They start thinking about it later when they're looking to retire, and then they're like, holy crap, I've missed out on like 10, 15, 20 years, and now I need to invest so much more every month now that I'm like 45 to make up for all those years that I didn't do it. So starting out by focusing on your savings right when you're young, to build good habits, to get used to putting money away, it's one of the best things you can do, for yourself and your future. But if you just stick to it and put money away and realize that, you're not going to get rich overnight. Like I said in the previous step, the compounding is going to pay out in the end years, but you just need to get started, and motivate yourself to get started. You are going to be like literally eons ahead of everybody else. Okay, number 4. It is much more damaging long term to sell winners too early than it is to hold on to losers too long. So what this means is, if you were lucky enough to invest in one of these generational companies, one of these companies that allows you to be lucky enough to invest in it, and one of these 100x opportunities where you can experience exponential growth over, let's say, a decade. I would classify Apple from 2010 to 2020 in this category. Amazon, same thing. Now they're kind of more, mature businesses, still great investments, but that huge exponential growth from 0 to 2 trillion, that's happened. I would classify Tesla as a company that's right now in its early mid hyper growth phase. And these types of companies that are truly incredible, that create a product or service that everybody wants, that really changes how we live. Like, think about how Apple, the iPhone, changed how everybody lived, how Amazon changed how everybody lived. Those types of investments don't come around that often. And to sell them early after you've, let's say, doubled your money. Like, how many people sold their Apple stock in 2013 after maybe their shares went from $100 to $150, and they were like, wow, I made 50%. This is amazing, right? Which it is amazing, but think about how much compounding they missed out on. So don't obsess over, oh my goodness, I bought a loser and I'm still holding it, I'm holding the bag. That's going to happen to everybody, and it's truly not the most damaging thing to your portfolio long term. What's most damaging is selling these amazing companies way too early. So if you can avoid doing that, you are going to be much farther ahead than obsessing over the fact that you maybe didn't buy the best company. All right, I forget what number we're on, but next one is the obsession with the PE ratio for every company needs to end, okay? PE ratio is excellent for assessing mature companies that are done growing, they're coasting, okay? Their growth is pretty much over, they're stable, they're just on coast mode, like, for example, the Canadian banks, utilities, telecoms, those types of things. PE ratio is a horrendous metric for assessing early hyper growth companies. Again, this is another reason why I think that everyone got Tesla so wrong a few years ago, because their PE ratio is over 1,000. It's just, I think now it's like, I don't know, what is it now, like 100 something with the recent earnings, but what people fail to recognize is that they're not accounting for exponential growth, because our minds cannot simply understand. So they see the 1,000 PE ratio and they're like, oh, this is an overvalued company. What they don't see is exponential growth is about to occur, that it's going to squash and compress that PE ratio to normal levels. And with these hyper growth companies, once the PE ratio reaches that normal number that looks good as an investment, their hyper growth is over. You've missed out on that exponential growth curve, and you're investing in that company as a now mature company. Like, if you invested in Apple right now, it's a mature company. It's growing, but it's not growing at the rate that it ever it did over the last 10 years. So long story short, quit the obsession with PE ratio, especially for growth companies, because it's just not the best metric to use. But I get it, it's an easy thing for most people to understand. It's price to earnings ratio, it's a number, you want it to be kind of low, like 15 to 30. It's easy thing for people to grasp. So it's an easy thing to be like, yes, PE ratio, good investment. PE ratio too high, bad investment, because it's caused a lot of people to bypass some of the greatest high growth tech investments that have happened over the last 20 years just by this obsession and fixation over the PE ratio. Number 6, in my humble opinion, portfolio rebalancing is a load of crap. If you do nothing, over time, your portfolio will concentrate itself into your winners, because the winners are going to go up exponentially while the losers go down, and so they become a much smaller percentage of your portfolio, and that will happen naturally if you do nothing. And isn't that what we want to do? Like, have our winners win and make our losers a smaller percentage of our portfolio? It doesn't make any sense to me to sell your winners in order to buy more losers in the name of rebalancing. So this portfolio rebalancing thing, at least for me, a young person who's relatively okay with volatility and is in the the hyper growth phase, let's say, of their portfolio, I just think this rebalancing is a load of crock. I'm not selling my winners to buy more losers. Number 7, holding and doing nothing is the hardest part of investing by far. The vast majority of good investing is literally just buying good companies or buying the broad market ETFs and holding. And it's so paradoxical, right? Like, the hardest thing is to take no action, but we just so desperately want to be involved and hands-on with our portfolio, which most of the time ends up badly for us, right? And I think part of this is the stock market is inherently volatile, and we have a strong emotional attachment to our monies, and so that desire to preserve our capital is so intense that it's difficult for people to literally just hold for at least 10 years. I think this is something that needs to be talked about more, because I think we need to meddle less with our portfolio and literally do nothing. Just sit back on the deck, relax, and let the compounding happen for you. All right, guys. Well, I hope you enjoyed. Please like if you like the video, subscribe, and you can also follow me on Twitter at Mrs. Invest1. And let me know your thoughts on all these points. And as well, I'm sure I've missed some really amazing investing truths. So share your wisdom down below. I would love to hear what you would add to this list. Let me know your thoughts, and have a great day. I'll see you guys in the next one. Bye.